Are you dreaming of breaking free from the 9-to-5 grind? Imagine earning a steady income without the daily commute or office politics. In this video, we'll explore 10 high-yield ETFs that could help you achieve financial independence. These ETFs offer attractive yields and the potential to generate passive income, allowing you to reclaim your time and live life on your terms. ETF number 1. Vanguard High Dividend Yield ETF, VYM. Ticker: VYM Yield. Approximately 3.5% expense ratio. 0.06%. VYM focuses on high-yielding U.S. companies, providing broad exposure to dividend-paying stocks. With its low expense ratio and diversified portfolio, it's a solid choice for investors seeking reliable income. ETF number 2. iShares Core High Dividend ETF, HDV. Ticker: HDV Yield. Around 4% expense ratio. 0.08%. HDV targets high-quality U.S. companies with strong dividend histories. Its focus on financial health and sustainability makes it a dependable option for income-focused investors. ETF number 3. Invesco S&P 500 High Dividend Low Volatility ETF, SPHD. Ticker: SPHD Yield. Approximately 4.5% expense ratio. 0.30%. SPHD combines high dividend yields with low volatility, aiming to provide stable income with reduced risk. It's ideal for conservative investors seeking steady returns. ETF number 4. iShares Select Dividend ETF, DVY. Ticker: DVY Yield. Around 3.8% expense ratio. 0.39%. DVY invests in U.S. companies with a consistent history of dividend payments. Its diversified approach across sectors offers balanced exposure to income-generating stocks. ETF number 5. SPDR S&P Dividend ETF, SDY. Ticker: SDY Yield. Approximately 2.5% expense ratio. 0.35%. SDY focuses on companies that have consistently increased dividends for at least 20 consecutive years. It's a testament to stability and long-term growth in dividend income. This segment covers the first 5 ETFs, providing insights into their yields, expense ratios, and investment strategies. Each offers a unique approach to generating passive income, bringing you closer to financial freedom. Would you like me to continue with the next segment, covering ETFs number 6 through number 10? ETF 4. JEPI, JP Morgan Equity Premium Income ETF. Now let's talk about JEPI. The JP Morgan Equity Premium Income ETF is often hailed as one of the most reliable high-yield ETFs on the market. JEPI combines low-volatility stocks with options income strategies to deliver monthly dividends and consistent performance. JEPI isn't just about chasing returns, it's about balance. It uses a covered call strategy to generate income while holding a carefully selected portfolio of U.S. large-cap stocks. Investors seeking passive income often flock to JEPI for its strong risk-adjusted returns and the monthly payout consistency. In fact, many retirees and early financial independence, retire early movement participants see JEPI as a core holding for dependable cash flow. Its yield often sits between 8% and 10%, depending on market conditions, making it a strong contender for replacing or supplementing your paycheck. What sets JEPI apart is its balance. It's designed to reduce volatility while still generating serious income. If your goal is to receive regular payments without worrying about extreme market swings, JEPI could be your new best friend. ETF 5. RYLD, Global X Russell 2000 Covered Call ETF. Next up is RYLD. This ETF follows a covered call strategy but focuses on the Russell 2000, which includes small-cap stocks. That makes RYLD unique because it taps into the smaller, often more volatile companies, while smoothing the ride with option premiums. RYLD generates income by writing covered calls on the Russell 2000 index. This can produce eye-popping yields, sometimes up to 12% annually. But here's the catch. You're giving up some upside potential in exchange for that income. Still, for income-focused investors who want monthly distributions, RYLD delivers. This ETF is particularly useful if you want to add diversity to your income strategy. Instead of relying solely on large-cap plays like JEPI or SCHD, RYLD brings in the small-cap exposure and pairs it with a reliable income stream. ETF 6. QYLD, Global X Nasdaq 100 Covered Call ETF. Let's move to QYLD, a sibling to RYLD but focused on the Nasdaq 100. QYLD has gained significant popularity among income-seeking investors. Its yield is often in the 11%–12% range, which turns heads quickly. QYLD uses the same basic strategy, covered calls on the Nasdaq 100. But because it's targeting tech-heavy stocks, the risk-return profile is different. You get consistent income, yes, but you're also capping your upside potential during big tech rallies. For those who are looking to live off dividends or build a secondary stream of income without betting on volatile stock gains, QYLD fits right in. It's a hands-off, rules-based strategy that delivers income like clockwork. Just remember, you're trading growth potential for consistency. And if that's what you need to walk away from your 9-to-5, QYLD may deserve a spot in your portfolio. ETF 7. DEVO, Amplify CWP Enhanced Dividend Income ETF. DEVO might not make flashy headlines like QYLD or JEPI, but it's a serious player in the high-yield ETF arena. DEVO combines high-quality dividend stocks with an active covered call strategy. That means the fund managers pick the stocks and decide when to write options to enhance returns. This ETF is designed for stability, income, and modest growth. It's not the highest yielding on this list, typically offering around 4% to 5%, but it brings an intelligent, disciplined approach to income generation. For those who want a more selective and actively managed income strategy, DEVO offers an excellent alternative. Think of it as the smart investor's option, one that won't give you the highest check each month, but might give you more peace of mind over the long term. ETF 8. SDIV, Global X Super Dividend ETF. If you're hunting for yield above all else, SDIV should definitely be on your radar. This ETF provides exposure to 100 of the highest dividend-paying equities globally. That means you're not just relying on US stocks. SDIV taps into companies all around the world. What's the big appeal here? A whopping yield that sometimes touches or even exceeds 12%. That's serious monthly income, enough to easily begin replacing a portion, or even all, of your 9-to-5 income depending on your investment size. But remember, with great yield comes great responsibility. Higher yields can also mean higher risks. Some of SDIV's holdings are in riskier sectors or regions, so diversification within your income strategy is key. You might not want this to be your only ETF, but it's a powerful addition. What makes SDIV stand out is its global exposure. If you're looking to diversify your income stream beyond US borders and get paid every month while you sleep, SDIV offers a compelling opportunity. ETF 9. NUSI, Nationwide Nasdaq 100 Risk Managed Income ETF. NUSI is the ETF for investors who want income and downside protection. It's a bit more defensive in nature compared to others on this list. NUSI holds the Nasdaq 100 and uses an options collar strategy to generate income while limiting downside risk. What's a collar strategy? It involves buying protective puts and selling covered calls, essentially putting a safety net in place. This helps limit losses in a downturn while still collecting a decent yield. The yield is typically in the 7% to 9% range, which is solid considering the protection baked into the strategy. NUSI is for those who want peace of mind and monthly income, without worrying too much about big losses if the market takes a dive. It's like the ETF version of income with insurance. If you're cautious but still want to ditch the day job and lean on investment income, NUSI might be the steady hand you're looking for. ETF 10. HNDL, Strategy Shares Nasdaq 700 Index ETF. Finally, we have HNDL, which is designed specifically to generate a consistent 7% annual distribution, paid monthly, while also providing some growth exposure. Handle is unique because it's a fund of funds ETF. It invests in a blend of other ETFs across stocks and bonds. That 7% target yield makes it incredibly appealing for anyone looking to build a reliable income stream. And because it's diversified across asset classes, it offers more stability compared to pure equity income ETFs. Handle is like a set-it-and-forget-it option. It automates the income generation process and keeps the risk relatively balanced. If you're new to the investing world or want a one-stop shop for monthly cash flow, this could be your launchpad to financial independence. So what does this all mean for replacing your 9-to-5? Let's connect the dots. These ETFs don't just pay you monthly. They provide predictability, scalability, and freedom. By building a portfolio made up of several of these high-yield ETFs, you can create a diversified, consistent income stream. Enough to pay the bills. Enough to buy back your time. Enough to leave that office cubicle behind for good. But let's be clear, this isn't a get-rich-quick scheme. Building a 9-to-5 replacing income through ETFs takes planning. You need capital. You need patience. And you need to reinvest those dividends, at least at first. It's like planting seeds that grow into income trees. Once you hit that magic number, where your monthly dividends cover your living expenses, you're financially free. Not just rich, but truly free. How to structure your high-yield ETF portfolio for maximum income. Now that you know the 10 powerful ETFs, the real question is, how do you build a portfolio that pays you enough to leave your job? The answer lies in smart allocation, realistic income goals, and using time as your greatest asset. Let's break it down. Step 1. Know your monthly income target. Start by asking, how much do I actually need per month to live comfortably without my 9-to-5 income? Let's say your monthly expenses are $3,000. That's $36,000 per year. To generate that passively, you'll need to reverse engineer your portfolio size. If your average ETF yield is 7%, then $36,000 divided by 0.07 equals $514,000. That means you'll need just over $500,000 invested in high-yield ETFs to generate that $3,000 per month. If that sounds huge, don't worry. That's the end goal. The journey there starts smaller, with compounding and smart reinvesting. Step 2. Mix and match for stability and growth. Don't just throw everything into the highest yielding ETF. That's tempting, but it can backfire if that fund cuts its payout or crashes. A strong portfolio includes 3 to 4 core income ETFs, SCHD, JEPQ, JEPI, or HNDL. These are your stable income engines. 1 to 2 growth-focused income ETFs, like QYLD or NUSI. These bring yield but also some risk-reward balance. 1 global exposure ETF, such as SDIV, adds geographic diversification. 1 to 2 monthly payers, like O, RYLD, or NUSI. These help smooth cash flow. By spreading your investments, you're not relying on any one fund to carry the load. Step 3. Reinvest until you don't have to. In the beginning, reinvest your dividends. Every dollar compounds. If you're starting with $10,000, use dividend reinvestment programs, DRIPs, to automatically buy more shares. Here's the beauty. Those reinvested shares pay their own dividends. That snowballs into larger payouts. This is how investors build 6-figure income machines without constant effort. Eventually, when your income reaches your lifestyle threshold, you stop reinvesting and start withdrawing. Step 4. Avoid income leaks. Taxes matter. You built the income. Now protect it. High-yield ETFs can trigger tax consequences, especially if held in a regular brokerage account. Consider this. Use Roth IRAs. Dividends grow and withdraw tax-free. Use traditional IRAs, 401ks. You'll defer taxes but pay later. Taxable accounts. Use qualified dividend ETFs like SCHD for lower capital gains taxes. Pairing tax-advantaged accounts with high-yield ETFs is the silent strategy of wealthy investors. Step 5. Set rebalancing checkpoints. Just like your car needs oil changes, your portfolio needs regular checkups. Are your ETFs still paying strong yields? Has any fund underperformed badly? Is your income still on track? Shift allocations if necessary. Remove weak performers. Add new opportunities. This keeps your portfolio fresh and functional, without the grind of a 9-to-5. The emotional side of quitting the 9-to-5. Let's get real for a moment. Leaving your job isn't just about the math. It's emotional. It's about identity. For years, your life may have revolved around work. Now, you're stepping into a new phase, on your terms. But the transition can be scary. That's why ETF income isn't just about money, it's about confidence. Every dollar you earn from dividends gives you peace of mind. That monthly cash flow becomes your new paycheck. And guess what? You didn't trade your time to earn it. The slow path is the fastest one that works. Everyone wants fast results. But fast money often fades. This strategy works because it's consistent, reliable, boring, even. But boring makes you rich. It's the person who buys $500 worth of ETFs each month for 10 years who wins. Not the person jumping in and out of hot stocks hoping for the next moonshot. Consistency beats intensity. And if you stay on this path, one day you'll wake up, check your brokerage app, and see dividends hit your account, without lifting a finger. That's when you realize, you've already replaced your 9-to-5. Quietly. Strategically. Powerfully. Coming up next, now that we've covered all 10 ETFs and the exact strategy to build your passive income stream, the final section will explore the biggest mistakes people make with dividend ETFs, how to avoid yield traps, realistic timelines and sample paths to $1,000 per month, $3,000 per month, and $5,000 per month in passive income. The 3 biggest mistakes people make with high-yield ETFs. Now that you're almost ready to build your income machine, let's talk about how not to sabotage your progress. Mistake number 1. Chasing yield without looking under the hood. It's easy to see a fund offering a 12% yield and think, this is it. I found the golden goose. But high yield doesn't always mean high quality. Some ETFs boost yields by sacrificing growth or dipping into capital. This means the payout is unsustainable. For example, if an ETF consistently pays more than it earns from dividends or covered calls, it may erode its own value to meet those payouts. What to do instead? Always check the total return, NAV trends, and distribution consistency. A solid 7% yield from a stable fund is better than a shaky 12% yield from a fund that's slowly bleeding value. Mistake number 2. Putting everything in one ETF. No matter how good a fund looks, you never want to rely on a single ETF for your financial freedom. Markets change. Rules change. Yields fluctuate. If that one fund cuts its dividend or crashes, your income vanishes. Solution: diversify across 5 to 7 ETFs with different strategies, asset classes, and payout schedules. Combine covered call ETFs like JEPI with dividend growth ETFs like SCHD, and sprinkle in monthly income ETFs for cash flow consistency. Mistake number 3. Ignoring taxes until it's too late. Many beginner investors assume all dividend income is free money. But Uncle Sam disagrees. If you're earning $1,000 per month in a taxable account, you could lose a big chunk to taxes, especially if those dividends are non-qualified. Pro tip: learn the difference between qualified and non-qualified dividends. Invest tax efficiently. And don't ignore retirement accounts. They can multiply your returns just by shielding income from taxes. The yield trap. How to spot it before you fall in the yield trap is what happens when you get lured into a high-yield ETF that's on the decline. These traps often Offer unusually high yields above 10%. Use return of capital to fund dividends drop in price even while paying high income. Here's how you avoid them. Checkmark. Check historical performance over 5 to 10 years. Checkmark. Look for steady NAV, net asset value. Checkmark. Read distribution breakdowns, especially the return of capital sections. Checkmark. Make sure the fund isn't just using leverage or selling assets to sustain payouts. Remember, yield without sustainability is just financial bait. Realistic income timelines. From $100 to $5,000 a month. Let's get practical. Here's what it actually looks like to build up your ETF income. These are ballpark estimates based on average 7% yields and monthly reinvestment. $100 per month in passive income goal. $17,000 invested timeframe. 1 to 3 years with $500 to $1,000 per month contributions. $1,000 per month in passive income goal. $170,000 invested timeframe. 5 to 10 years with consistent investing. $3,000 per month. Replace 9 to 5 goal. $514,000 invested timeframe. 10 to 15 years depending on your contribution rate and reinvestment discipline. $5,000 per month. Early retirement goal. $857,000 invested timeframe. 15 to 20 years unless you start with a lump sum or earn high income. This is the long game. But once your portfolio hits that critical mass, your job becomes optional. That's freedom. Bonus strategy. The ETF ladder for monthly paydays. If you're focused on cash flow, consider building a dividend ladder using ETFs that pay at different times of the month. Example: Week 1. RYLD Week 2. SCHD Week 3. JEPQ Week 4. QYLD. Now you're not just getting paid monthly, you're getting paid weekly. It's like creating your own paycheck schedule. You can also combine this with bond ETFs, preferred equity ETFs, or real estate income funds for further diversification. Final thoughts. Build quietly, win loudly. Let's bring it all together. The traditional job isn't going away, but for some of us, the desire to reclaim our time is stronger than ever. High-yield ETFs give you a legal, scalable, and quiet way to build a paycheck that never clocks out. You don't need to day trade. You don't need to time the market. You just need discipline, patience, and a blueprint like the one you've learned today. Start small. Invest consistently. Reinvest everything. And keep your eyes on your freedom number. Because while most people wait for retirement at 65, you're building a system to exit the 9 to 5 quietly, perhaps even in your 30s or 40s. And you're doing it with tools anyone can access, but very few actually use correctly. The road is yours. The 10 high-yield ETFs are your vehicles. Your job now? Get in, drive smart, and never look back. What happens when you finally reach your freedom number? Let's say you've hit your magic number. Maybe it's $514,000 for $3,000 per month in income. You've reinvested, stayed disciplined, and now you're ready to live off dividends. What now? This is where mindset matters more than math. Most people think once you retire early, you just sit on a beach. But the truth? You evolve. You build. You live with intention. And the income? It just keeps coming. You start waking up without an alarm clock. You choose projects you love. You pick your kids up from school every day. You're not chasing time anymore, you own it. But here's what no one tells you. You must protect your freedom. Protecting your income stream. The 4 core defenses. 1. Emergency fund. Don't withdraw from your ETF portfolio for emergencies. Always keep 6 to 12 months of expenses in a high-yield savings account or money market fund. 2. Recession buffer. If a market crash hits, ETFs may lower their dividends. Be ready by reducing spending or maintaining a secondary income stream temporarily. 3. Inflation shield. Use ETFs like VYM or SCHD that include dividend growers, not just high yielders. Dividend growth helps your income keep pace with inflation. 4. Reinvestment strategy. Even if you start withdrawing, keep reinvesting a portion, 25% or more, to keep your portfolio compounding. This is what keeps your passive income rising even after you retire. Common questions that you were probably thinking: can I live entirely off dividends? Yes, many do. But the key is hitting your number and preparing for variability. Dividends aren't fixed like a salary. Build in buffers. What if a fund cuts its dividend? That's why you diversify. A cut from one ETF won't break you if you hold 5 to 7 solid positions. Always review your portfolio annually. Are ETFs safe for retirement? High-yield ETFs are generally considered safer than individual high-yield stocks. The diversification and management structure help reduce risk. But no investment is completely risk-free. That's why education is power. The 10 ETF Blueprint Revisited in action. Let's revisit the 10 ETFs, but this time in context of real strategy. JEPI, Core Income Generator. Ideal for middle of portfolio. JEPQ, High Yield with Growth Flavor. Adds Tech Income Power. QYLD, Monthly Paychecks. Use cautiously, great for near-term needs. RYLD, another monthly source. Best used with balanced ETFs. XYLD, S&P 500 coverage with covered calls. Useful for equity income. SCHD, Dividend Growth King. Should be 15 to 25% of long-term core. VYM, Diversified Large Cap Income. Broad Safety Net. DEVO, Quality-Focused High Dividend ETF with upside. SPHD, High Dividend, Low Volatility. Great for stability. HDV, Healthcare plus Consumer Dividend Strength. Excellent for aging portfolios. Each one plays a role. Think of this like building your own private income trust. Each ETF is a tenant paying you rent, some every month, some every quarter, but together, they cover your entire financial property. Real-world scenarios. Let's walk through some sample stories of how this works in real life. Case Study 1. Mike, age 28. Software engineer. Mike invests $1,000 per month split between SCHD, JEPI, and JEPQ. After 8 years, his portfolio is worth $130,000. He earns $760 per month in income. He adds a side business that covers the rest of his bills. He stops his 9 to 5 by age 36. Case Study 2. Tanya, age 41. Single mom. Tanya receives a $150,000 inheritance. She puts $50,000 into her kids' college funds and the rest in a blend of VYM, SPHD, and HDV. Within 3 years, she's earning $700 per month. By year 5, she adds more and reaches $1,200 per month. She keeps her job, but now she works part-time, by choice. Case Study 3. Raj, age 33. Uber driver. Raj doesn't earn a high income but is consistent. He saves $500 per month and adds $2,000 per year in tax refunds. After 10 years, he's built a $95,000 portfolio yielding $6,000 annually. It's not enough to retire, but it pays his rent, freeing him from stress. Beyond ETFs. The hybrid model. While ETFs can replace your job income, you can accelerate the process by pairing them with online side income, YouTube, ebooks, affiliate sites, rights for real estate exposure tips, ETFs for inflation protection, municipal bond ETFs for tax-free income, international dividend ETFs to diversify beyond the US dollar. Your ETF portfolio becomes the bedrock, the passive income engine, and everything else becomes the bonus fuel. The millionaire math no one teaches in school. Let's get raw. Here's the truth about the average American. Works 40 plus years, retires at 65, has $100,000, $200,000 in savings, still relies on Social Security. Now let's look at your new math with ETF income. Invests early, reaches $500,000, $800,000 by 45, earns $3,000, $5,000 per month, passively chooses how, when, or if to work. The best part. You don't need a huge salary. You need a system. This is that system. And ETFs are your gear. One final word. Don't tell everyone this strategy is powerful. But not everyone will understand. People will tell you it's risky, that it won't work, that it's too slow. They're wrong. They're thinking in the old paradigm, the one that traps you in a job for 40 years. You've just unlocked a smarter way. So build quietly. Stay consistent. Keep your portfolio growing. And let the results speak for themselves. When they ask how you escaped the 9 to 5, you can smile and say, I just followed the dividends.